Hi everyone, welcome to today's video. Last session we saw how one can calculate the corpus required for retirement. We took an example of a 22-year-old who wants to retire at age of 46, and we calculated that the person would require at least 1 crore using 4% rule. In today's video, we are going to see how one can go about building the corpus for retirement. We have many instruments available, but I'm going to list down top 5. I'm going to list them down in ascending order of risk level, starting with low risk and then ending with high risk. The first instrument we are going to say is EPF, or Employee Provident Fund. It is managed by EPFO under the supervision of Ministry of Labor. In this fund, an employee can contribute 12% of his or her basic salary and dearness allowance, and another 12% by the employer. This offers a interest rate of 8.1%. Now let's look at the pros of EPF. Number 1, it falls under EEE category of taxation. That means your original investment, interest earned, and the maturity amount, all three are exempted from taxation. Number 2, it is safe because it is guaranteed by government. Number 3, partial withdrawals are allowed in case of any medical emergencies or children education, or if you want to buy a plot or house. In fact, you can withdraw entire corpus if you make early retirement after 2 months of your resignation. Now let's look at the cons. Of course, the interest rate is just 8.1%, little better than interest rate offered by FD. After adjusting for inflation, it is really not that attractive. Now let's move on to a second instrument, NPS, or National Pension Scheme. It is provided by Government of India and managed by PFRDA. It's a voluntary savings scheme in which an employee can contribute up to 10% of their basic salary and dearness allowance plus 50,000 as voluntary contribution. It has historically given a return of anywhere between 8 to 10%, better than EPF. Now let's look at the pros of NPS. Number 1, it again falls under EEE category of taxation. That means your original investment, the interest earned, and the maturity, all three are exempted from taxation. Number 2, you get exposure to equities. In fact, up to 50% of your contribution can get exposed to equity. That means better return compared to EPF. Number 3, the contribution of 10% of basic salary and DA and additional 50,000 towards NPS are exempted from taxation. This is over and above 1.5 lakhs offered by ATC, which could be used to build corpus for any other financial goals. Now let's look at the cons of NPS. The only shortcoming I find with NPS is you cannot withdraw entire corpus as lump sum after retirement. You can only withdraw up to 60% of your corpus as lump sum, and the remaining 40% should be converted to an annuity plan with LIC or SBI or any other pension fund managers. That means you do not have control over the corpus that you built for your retirement. You simply hand it over to a fund management company like SBI and LIC to manage your pension. Furthermore, if you retire early, you have to convert 80% of your corpus into annuity plan. Let's look at the third instrument, equity mutual fund. What is equity? Equity in simple terms are shares of a company. What is a mutual fund? If you are an investor who does not have competency or time to pick and invest in stocks directly or shares directly, then mutual funds come to your rescue. All they do is they take money from you and then invest in stocks on your behalf. There are many kinds of mutual funds, namely equity, debt, hybrid, index funds. Pros of investing in equity mutual fund. Number one, attractive return. In fact, most large cap mid funds or index funds have yielded a return of at least 12% in 20-year investment horizon. It means you can build your corpus relatively at faster pace than EPF or NPS. Number two, the capital gains are tax exempted if you sell your units anytime after 1 year. Number three, high liquidity. It means you can withdraw your corpus anytime you like, unlike in EPF and NPS where you have a lock-in period of at least 5 years and 10 years respectively. Now let's look at the cons of equity mutual fund. Number one, it's highly volatile. It is subject to market ups and downs. Number two, if you want to invest in a mutual fund, you will have to do a little bit of research to identify a fund that suits your needs. Or you will have to consult your investment advisor. Number three, expense ratio. Since most mutual funds, except index funds, are actively managed by fund managers, a fraction of your contributions are deducted for meeting the operational expenses. That means your potential returns could be impacted by the expense ratio. Hence, you should always keep an eye on the expense ratio of a mutual fund. It goes without saying that you should choose a mutual fund which has a low expense ratio. Now, I have a tip. If you are keen to get started with mutual fund, then get started with an index mutual fund because index funds are passively managed. That means the expense ratio is low and your potential returns are relatively higher than any other actively managed mutual funds. If you want to learn more about mutual funds, then visit ET Money, Coin, or In Money apps. Now let's look at the last instrument available for us, direct stocks. If you are passionate about equity research and you have time to go through the financial reporting and have the competency to understand the business model and the macroeconomic factors affecting the sector in which the company operates, then you can pick and invest in shares of the company. Let's look at the pros of investing directly in stocks. After thorough research, if you invest in a stock and that turns out to be a multi-bagger, then your investment could grow many-fold at very fast rate. Cons. Since it requires time and effort to do a thorough research of financial health of a company, it is not for all. Number two, it is subject to market volatility. That means your investment could go up or down depending upon the moods of the market. With this, we have come to the conclusion of list of instruments available for building your retirement nest. Now is the moment of truth. Now let's look at how long it takes to build a corpus of 1 crore by the 5 different instruments. Let's start with EPF. To build a corpus of 1 crore by investing 12,000 every month, it takes approximately 24 years to build a corpus of 1 crore. Now let's look at NPS. It takes approximately 22 years to build a corpus of 1 crore by NPS at the rate of return of 9.4%. It is little faster than EPF. Now let's move on to equity mutual fund. Let's assume that you invest in a Nifty index fund. It takes approximately 19 years to build a corpus of 1 crore at the CAGR of 12.2%. It's certainly faster than EPF and NPS. Now let's move on to direct stocks. Let's make an assumption that you have picked a multi-bagger stock and that grows at a rate of 15% every year. Then it would take 15 years to build a corpus of 1 crore if you invest 12,000 every month. In conclusion, equity mutual fund will be the right choice to build a corpus in long term for the following reasons. Number one, it gives you better control over your corpus. Number two, it gives you attractive return compared to EPF or NPS. Number three, it gives you high liquidity. That means you can withdraw anytime you like. With this, we have come to the end of the video. Hope you found this video useful. If you like it, please share with your friends. And if you have any queries or comments, please leave them in the comment section and I will get back to you. In our next video, we will see how one can plan their financial goals using a personal finance framework. Till then, take care. Bye.